For more on the market impact, let's turn to David Kelly, Chief Global Strategist at JPMorgan Asset Management. We obviously didn't get the jobs report today, but you were expecting about 60,000 in September. What do you think is the path of least resistance for the market amid this some sort of catalyst void coming from the government?
Yeah, well, it's not quite a void. I mean, admittedly, the government is shut down, but we do have indicator models which we use to forecast these variables. And as you said, we thought that number would be about 60,000. We actually have a lot of private sector indicators which can feed into this. So we can get some sort of sense of where we are. But where we are is an economy which is growing more slowly. It's heating up in terms of inflation. And the outlook, of course, is just getting cloudier and cloudier as we lack these government data. So from a market perspective, I am a little bit concerned here because the market is just blindly moving higher when really a lot of the fundamentals are deteriorating beneath it. And so I think investors need to be cautious here and recognize that there is clearly a disconnect between market euphoria and really some growing problems in the economy.
Why do you think that is? Why do you think the market may be ignoring some of the other warning signals? And do you feel like maybe the market would pay better attention if those government reports were to filter their way through?
Well, I think there's a sort of structural imbalance in the market. I mean, first of all, the vast majority of people putting money into the market are upper income individuals here and around the world. And so they're doing okay because of, the economy is doing okay for them. And they've also got huge wealth gains, so they don't feel badly about putting money in. But also people have huge embedded capital gains, so it's very hard to pull money out. So it's sort of this valve which lets money in but doesn't let it out. And I think the longer this bull market goes on, the more painful it is from a tax perspective to get money out. So there's sort of a disconnect here which could only be broken by a real shock to the economy. So if people are really scared about a recession or a huge credit event or some other huge event, then you get a gap down in the market, and that could be very painful. But for investors, you never know the hour nor the day when such a thing could happen. So I think it's just best to play it on the safe side and recognize that there is something a little irrational about how high the market is going and how well it is doing given this uncertainty.
Well, David, I'm trying to, withdraw some kind of messages from how the market is positioned and the degree to which the market has done very well, even as you've seen softening labor data, and some of the drivers of underlying consumption seem to be flagging a little bit. And one of them seems to be just a sense that come 2026, there are going to be some boosts to the underlying economy, right? You've written quite a bit about how it should be a heavy first quarter tax refund season for various reasons. You have other provisions that are about to engage, I guess, in terms of corporate investment. You're going to lap the tariff effects. So I'm just saying that's the sort of benign view of things and maybe what investors are trying to anchor to.
It is. If you want to rationalize it, I think that could be part of the story. And indeed, we're looking at a very soft patch in the fourth quarter, but it should be a short one because of all the sort of sugar rush of these refund checks in the first half of next year. But it is sugar, not protein, and it's not going to last. And so once people have paid, have used these refund checks, which they'll use them pretty quickly, by the second half of next year, this economy is going to slow down again. Because the tariff effects, the huge reversal on U.S. immigration, these things are lasting effects in the U.S. economy. So unless you get further doses of sugar from further fiscal stimulus going forward, there are some issues here. So I think it's easy enough to rationalize every move up in the market. You can find something to justify it, and certainly corporate profits are very strong, and long-term interest rates don't look particularly high. But I think there's still room for concern here when you actually look at what's going on with economic fundamentals.
Well, that's interesting, David, because yesterday the president did mention considering taxpayer refund or rebate checks of $1,000 to $2,000. We know we're going to probably get some farm bailout news on Tuesday. This Trump RX effort is clearly a soft measure to implement some kind of price controls going into the midterms. How much can policy do on that front?
Well, it could do quite a lot in terms of speeding up the economy short term. We know that consumption reacts very strongly to extra cash given to consumers. Unfortunately, inflation does also. And the problem with that really is that usually growth effects come first and the inflation effects come second. So I would not rule that out at all. And that may be temporarily beneficial for the stock market, but it would be very negative for the bond market because it really says that Any supposed improvement in public finances due to very strong tariff revenues are just going to be negated because we have to give money back to the people who are injured by the tariffs. So I think that's I think the message of the bond market is pretty negative from that. But yes, absolutely. I think we cannot rule out the idea that there'll be further fiscal stimulus before the 26th election.
So then might that explain why the markets continue to churn higher, regardless of some of the data, as you pointed out earlier in our conversation, that may suggest otherwise, that may suggest kind of a disconnect there. If the economy is growing and you've got easier monetary policy and the bond market is potentially going to suffer, then isn't kind of the equity market the best place to put your money right now?
Well, it's sort of a green light to the equity market, but the problem is, is that a green light at 15 times earnings or 18 times earnings or 20 times earnings or now 23 times earnings? So the market keeps on moving up on the same promise of a relatively anemic but stable economic growth picture, and eventually it's going to get overpriced. It may already have got overpriced in places. So again, for an investor, there's no, we don't see a recession as being imminent. We don't think we're going to have runaway inflation, so that's okay. But just look at prices and look at prices of all assets around the world, because there are cheaper places than mega cap U.S. equities. I think people just need to look at the concentration, make sure they're properly diversified. This may go on for some time, but if it goes wrong, it could go wrong in a bad way, and people need to be spread out across asset classes, not just focused on the things that have done the best this year and indeed for the last 2 years.
Good point. The increasing challenge of being diversified in the current environment. David, thank you so much for your time this morning. Appreciate